Let's check the crypto markets right now. I saw a little bit of weakness, but there was a rebound from last week. Recently, joining us now with more, John D'Agostino, Coinbase head of institutional strategy. And I want to talk AI and the convergence with crypto and some of these terms, and you can explain it to me. But here's a couple bullet points. AI made intelligence scalable and programmable. Crypto is doing the same thing for money and value. And when you put them together, it makes programmable money that can meet programmable intelligence. So this is all MIT lab type stuff, and this is like looking into the future.
Yeah.
What does it mean practically?
Sure. So I love that phrase, artificial intelligence as infinitely scalable intelligence. And if you think of blockchain, which is the underlying technology for crypto, as infinitely scalable source of truth, then those two things work very well together. The simple way of thinking about it is if we are moving to a world where AI agents will not just analyze things for you, will not just give you information to make your own decision, but will potentially be allowed to act on your behalf, then we want those agentic systems or those AI systems to act on true sources of information. It would be disastrous if they didn't. So simple examples could be AI agents not just analyzing your portfolio, but optimizing it. Tax loss harvesting, kind of simple rote things. We could live in a world, let's get away from finance for a second. We can live in a world where AI agents are able to conduct, and this is some of the work happening at MIT that we talked about earlier. We could be living in a world very shortly where AI agents are conducting screenings for cancer treatments. And the process of doing that involves maybe the purchase of data sets. And a scientist could do that 5 times a day. An AI agent could do it 5,000 or 5 million or 5 billion times a day in theory. For that AI agent to purchase that data set, to do that experiment at that scale, to ask it to rely on 100-year-old financial rails, it's sort of like trying to stream K-pop Demon Hunters on a 1994 dial-up modem. It just simply doesn't work. So if we're going to move to this world and have this wonderful advantage of these agents acting at infinitely fast speeds, they have to act on infinitely fast and scalable money rails. And that's what blockchain and crypto is.
Because, and I've always been fascinated by the singularity when machines know 1 billion times the sum total of all human knowledge. We have no idea what that.
You have no idea
what that means.
Right.
But when you say something it's fascinating. So it is infinitely scalable AI, and
infinitely is a bit hyperbolic. I'm not sure anything is infinitely scalable.
Right. But infinitely scale. You need a financial instrument that is also infinitely scalable to handle what you're talking about.
Correct. And when we talk about programmable, it's flexibility in terms of we don't know where these agents are going to go. We don't know the advantages they'll give us. And so having money that's flexible, being able to do different things with it, that's equally important. But I think the basic is just think about just speed, right? You wouldn't try to stream a movie on a dial-up modem. We wouldn't ask these AI agents to transact with a financial system that's older than those modems.
Bitcoin has come a long way from Beanie Babies when you talk that way, has it not? There has been, obviously a lot of volatility, and you say that we got to get the crypto to a point where it's not just correlated with tech stocks. They go up, tech stocks come down, crypto comes down. Do you see that happening? Do you see progress in that? It still looks like a risk-on asset, does it not?
Yeah, I mean, I do. I mean, so last time I was on, we were talking about the decoupling of Bitcoin with tech stocks and its outperformance relative to gold. Now we've seen year to date gold doing really well, up 46% or so. Bitcoin doing well, up about 21%. Ethereum up about 25%. So it's decoupled in the opposite direction. But push back year on year, gold's up about 44%. Bitcoin's up 75%. Ethereum's up 58%. And even if you look at something like the Coin 50 index, a basket of crypto, that's up about 72% year on year. Now, if you go back 3, 5, 7 years, there's no question which is the better asset to own. But here's the rub. Here's the crazy part. you don't have to choose, right? This isn't a who's the GOAT, Jordan or LeBron conversation. Bitcoin has characteristics gold doesn't. It's programmable. It's digital. It's infinitely scalable in terms of movement. Easy to move. You don't have to lug gold across borders.
Right, insured.
And most importantly, I would argue it produces yield, where gold has a negative cost of carry. So if you're one of the people who are genuinely concerned that global money supply grows like 7-8% a year, and that's excessive, if you believe that's excessive and that's causing inflation, then you need assets that will beat that. A couple $1 trillion was sitting in money markets because at 5%, 4.5%, 5.5%, that's nice. You're getting close to beating your target inflation rate.
Yeah.
As rates tick down, that unlocks those assets. Now, all of it's not flowing into assets like Bitcoin, but a portion will. That's what makes us bullish.
And institutional crypto investors probably aren't nearly as squeamish when there's, although a lot of retail they're hodlers and they haven't sold either. Right?
Yeah, so I'll know. So institutions are coming is sort of the most common question I get asked on panels. They've been coming, not just coming, they're there. They've been there for a long time. Everyone talks about this institutional wave. In my experience of dealing with pensions and endowments and sovereign wealth funds, they don't invest in waves. They're not lemmings running over a cliff in some giant wave. They're very, very cautious. They're very thoughtful.
So yeah. What percentage right now of Bitcoin do you think is held by ordinary individuals around the world versus institutions?
So I don't want to hedge, but the reason is if you view, say, like the BlackRock ETF, which has been enormously successful,
right.
Some people view that as an institution holding Bitcoin.
Right.
In reality, I view that as the ETF holders holding Bitcoin. So it depends on your perspective. I don't have good numbers for you. If you invite me back, I'll have good numbers.
80% is individuals? Do you think it's 90%? Do you think it's 50%?
I think it's the majority are held by individuals if you consider the ETFs as being individually held. Right. But if you invite me back, I'll give you exact numbers.
Okay.